Alan Darby, Jacqueline Martinez. This is the Buyer's Boardroom. Learn the most about who you are today and where you want to be after.
All right, back in the Buyer's Boardroom. How's it going, Alan?
It's going good. It's going good. Just a crazy few weeks. Lots of market volatility.
I
So
know,
every day you just wake up and wonder what's going to happen. Doesn't seem to be driven by anything like economically. It's just whoever's talking the loudest that day.
right?
So,
Yeah, absolutely. I know, and a lot of our clients talking about dealing with clients calling in and they're getting swayed by all the, news feeds and everything and keeping them calm
yeah.
and it makes our job a little bit more complicated too right now. All the deals that we have, post LOI or nearing LOI
Yeah.
and how will the market activity impact that? It's a big topic for sure.
Makes sense. Like, when acquisitions are priced on revenue or EBITDA, which is a function of revenue, and your revenue is being impacted sort of like mid deal. And by mid
Mhm.
deal, I mean like you've gotten to the point where you've actually signed an LOI, you've got real deal terms that are based on an expectation of revenue, but then along comes a market correction or a bear market. How does that affect the deal? And so I thought amidst this turmoil that we're currently going through, it might be a timely podcast to just pop out there and say, okay, how do buyers look at this? How do sellers look at this? Like, what typically happens? What conversations ensue? What potential remedies are there? And you're a pro at this, so like today, I'm gonna try to interview you on a few of these questions. Normally, you're asking me, but since
All
you're the
right.
you're the person on our team that tends to deal with these things, I figured I'd ask you questions, and of course, I'll give my opinion after your sage guidance as we go along. But
Good luck stumping me.
yeah, I haven't been able to do it yet, so maybe today's the day. So look, so right now, I think if our numbers are correct as we sit here, market's about down what 10% or so year to date, give or take. I know it seems like it
Depends on the
swings,
moment.
yeah, 1 to 3% a day these days. So that obviously affects revenue. So what? Just tell me, like from your perspective, what does that translate to in terms of revenue? Like if a market's down 10, what do you normally see in terms of revenue impact to a seller that we're working with?
All else equal, if markets were down 10%, like, no one's really invested all in equities, for example. So call it 60% of that or 6% on average, like everything else equal, no other organic growth activity that's made up for the market loss. Revenue could be down 6%. But then when we think about these transactions being based on EBITDA effectively, a lot of time that 6% of revenue comes right off of EBITDA. So it's a higher,
Percent.
because of all the fixed costs in the business. Yeah, it's
The
a higher
expenses
percentage
haven't
of,
been reduced, revenue
right,
has been reduced. And
right.
so like if it's a 10% market correction, I think what you're saying is whatever allocation to equities, which most advisors aren't allocating 100% of their client portfolios to equities. So let's say it's a 60-40, 50-50 standard
Right.
client allocation. A 10% market sell off might mean a 6% revenue drop, but that may mean a 10%
Maybe
EBITDA
closer
drop.
to 10.
Yeah,
Yeah,
yeah.
exactly.
So it's like revenue given the expenses, and assuming the seller hasn't adjusted any expenses, which they typically don't do early in a market sell off. It's a bigger impact to EBITDA. Okay, so we have this revenue decline, we have this EBITDA decline. The deal has already been struck based on legacy revenue, not factoring into this current decline. How do buyers perceive that? Like, what's their general frame of mind? Like, I would think that as a buyer, or not, I would think some sellers might think this buyer is looking to maybe strike a deal really quick, while my revenue is declined. I mean, do they reprice these things? How do they think about this from a buyer?
It's interesting because, if you think about the last 16 years, it's mostly been a bull run. So the
Mhm.
deal terms that are in these LOIs already has been more to the seller's benefit. And there's wording in there already, typically that says, you know, like in advance of signing the purchase agreement, we will adjust this to the then current revenue. Okay, well, that was based on the assumption that revenue is going to be increasing. And
Right.
so this is beneficial to the seller. Well, now it's backfiring, and so in this moment in time. And so now, us as sell side advisors, we're going to our clients and saying, look, this is how this will play out now if we don't go back and change the wording here to something else that's more equitable, because how this would play out is that your valuation would be cut by 10% effectively, is the punchline that's happening right now. And so those words were written at a time where it was beneficial to the seller. So
Yeah.
okay, well, now it's not, and we want to change it, and we're in a non-binding LOI, so it's the perfect time to do it. And on the seller side, they, like you were saying, they don't want to be penalized for the short-term decline. On the buyer side, they're not really looking to capitalize on the opportunity either, because this is a long-term partnership. So both parties are coming to this saying, we want to find a solution that makes sense for both of us. But on the buyer side, they have lenders, they have a board, they have private equity groups. All these parties involved here need to have a clear view of what EBITDA really is with the decline. Like there is a real change here, and it needs to be known. But at the same time, they can't be overpaying on that. But at the same time, there's different levers that we can use to make sure that as revenue repairs, that seller gets full value.
Got it. Got it. Yeah.
Yeah.
To your point on how they inserted language, I remember, and they still do largely, but like it was like 2022, I think, year end, there was a pretty big market correction. It was short lived, but kind of coming into that, all the sellers perceiving that, okay, we may be at a high, they all wanted to remove market from their retention based calculation. Every deal that closes, there's going to be a closing payment and then a retention payment sometime in the future, maybe a year or 18 months later, that's tied to revenue. And they were thinking, well, because we're at a high, let's remove the market calculation from that retention payment and therefore not have any risk there. Then along came that correction. And then all of a sudden in January, February of 2023, everyone wanted to change and say, let's insert market recovery into the deal to capitalize on that projected market recovery. So it is funny like how the sellers vacillate back and forth. But to your point, it's not as if either party is looking to be damaged by this short-term issue. Buyers are not trying to retrade the deal because of a short-term phenomenon and effectively buy you on the cheap because your revenue happens to be down. That's not the buyer's outcome, because as you mentioned, it's a partnership, and the last thing they want to have is an angry partner coming on into their team because they lost out on revenue due to something outside of their control. Sellers obviously don't want to transact and miss that valuation. So, well, okay, so I know how deals are structured, but for everyone listening, there's really two potential adjustment points to the valuation due to this short-term, let's say due to a market decline period. So where are the 2 points in the valuation calculation that a seller's valuation could be exposed due to market?
Well, the first one, like we were saying, is around, are we resetting the initial valuation based on where EBITDA really is today with this decline?
So you mean that's typically like the LOI. So you sign an LOI that has the deal terms in it. There's a period of time between the LOI and a closing. Is that what you're talking about?
Right. The period of time between the LOI and a closing where there's due diligence happening, and with the kind of the forecasted change in revenue with the decline, that revised EBITDA will be arrived at. That will just happen. We need to understand that. But it could be at that point where the buyer says to you, okay, we want to reset, we'll keep the multiple the same, but we will reset the valuation on this lower EBITDA.
So let's say that my LOI said that I was selling for $10 million, and forget the payout structure. and that was based on, $1 million of EBITDA. That's the LOI. But I know I've got 90 days till closing, or maybe even more, 120 days, let's say. Well, so before I sign partnership agreements, let's say, so that's 60 to 90 days after the LOI,
Yeah.
and the market goes down during that period between the LOI and the signing of purchase agreements. That's the period you're talking about, where the buyer could come back and say, let's look at what your revenue is now. We thought it was $1 million. Market's down 10%. EBITDA might be down 10%. Let's recalculate valuation. So instead of $1 million of EBITDA, it's now 900,000 of EBITDA.
Right.
That's what you're saying? So that's the first point of potential adjustment. And the second one would be what?
That would be about the retention payments and when are we calculating the achievement of those? And so say the deal that is in place right now in your LOI, it says that 60 to 70% will be paid at the closing, and the other 30 to 40%, let's say, is paid at the first anniversary. So at that point, let's say everything stays exactly where it is right now, then your retention payment would be at risk if the revenue is still at this depressed level at that time, and then it's at risk. So then it's about thinking about what are solutions that we could build in here to if we need more time, and we'll go into different ideas there next.
Okay, so my valuation, and let's use this $10 million scenario that was agreed on at LOI, and it was based on $1 million of EBITDA. And so the first point it could be at risk was during the point between LOI and signing definitive agreements. The market drops and the buyer wants to reprice based on EBITDA then. Okay, so let's say it drops. The second, and then we have a closing and they pay me 70% of the valuation, 30% is held in a retention. And let's say the retention, as you said, is a year out, so 12 months. If the market dropped then, at that retention period, my retention payment, that 30%, could also be at risk if the revenue wasn't there. Okay, so we have two scenarios where my revenue could be at risk due to market declines. Okay, now that we understand that, let's talk about ways that you could potentially solve for those, that both parties can agree that puts us in an even position where we're not being asked to bear risk that we didn't sign up for. In the seller's case, revenue is gone because of something out of your control. In the buyer's case, they're being asked to write a check for revenue that's not there. So we're not being asked to take on any risk, and we're both being made whole. The seller is getting full valuation for what they expected, and the buyer is getting the revenue that they expected to acquire. Okay, let's talk about the first point. Is we sign an LOI. We're marching towards signing purchase agreements. During that window of time, the market drops, kind of like what we're seeing happen today. What are some of the ways that we could think about solving for that, where both parties are coming out in a fairly treated manner?
What has been successful right now, and we have multiple ongoing conversations right now with live deals, is to leave that initial price, that 10 million in your example, leave that where it is, knowing that actual EBITDA is down a bit, but we don't know how long that will take to repair and those sorts of things, but leave the 10 where it is. And then when it comes time to make those retention payments at the 1 year mark, call it the 30%, so 3 million, that's based on retention of the revenue level that the deal was based on, which is higher than today. If at that 1 year mark, their revenue is not back up to the target level, then allowing the seller the ability to extend that measurement period and we're seeing, agreements being reached around like an extra 6, 12, 18 months. So pushing it into year 2, year 3 post the close, where the seller can say, I'm not at the target level. I want to roll forward and let's calculate this in another 6 months and see where we're at, giving markets time to repair, or that organic growth can help out with that difference as well.
Okay, so basically the buyer would be saying, okay, look, we know during this post LOI period, your revenue is likely down.
Mhm.
However, we're holding back in this scenario 30% of the valuation in this retention. We
Yeah.
believe that's sufficient to protect us. And therefore, we're going to give you that retention period in this scenario, a year, to see if the markets recover. If they recover, all is good. The buyer is getting what he's wanting, the seller is getting what they're wanting. In the event that the markets still haven't recovered at the retention calculation point, you're saying that we could insert the ability for the seller to say, hey, we're supposed to have this retention calculation at this date. Let's extend that calculation date for a period of time. And we've seen it typically in like 6-month increments. So maybe you negotiate an 18-month potential extension,
Mhm.
wherein we have just 18 more months of time for the market to recover, so that the seller isn't getting that retention payment at the presumed date originally agreed to. But the buyer isn't being asked to write a check either. So
Right.
both parties are somewhat protected here, and the goal is the market recovers in that 18-month period, right?
Right. Yeah.
Let me ask you this question: would it be fair? Another remedy potentially is if the buyer said, "Yeah, we will ignore this post LOI market dip, but instead of releasing 70% at closing, like we thought about, maybe we'll release 60,
Mhm.
and therefore increase our retention protection." Again, the seller isn't losing valuation; they're just pushing more of that valuation out into the future. Is that a plausible remedy too?
Yeah, I think that would be a nice solution as well. And it would be like perceived fair for on the seller side as well to have some, redistribution of the risk effectively. I think that
Right.
makes sense.
Yeah,
Yeah.
I think both of those. I think if you're level headed, see either of those remedies as potentially protective and not putting anybody at risk in that regard. I mean, obviously, another solution, Jacqueline, could be the seller just says, "Hey, we're going to walk. We're going to wait."
Yeah.
If the buyer said that, "Hey, we are going to we're going to recalculate your valuation during this post LOI pre partnership agreement period," the buyer wants to recalculate it and lower the valuation, the initial payment, the seller could say, "Nope, I'm not doing that."
And
What's
that's basically guaranteeing that outcome. If you go to them and say, we're bringing it down to 9, and there's no path for you to get back to 10 on the existing business, and just, yeah, no opportunity to recapture as the markets repair to get back to that, you're basically guaranteeing that the
the
seller would
seller's
walk
going to
away.
walk? Yeah.
Yeah.
Well, that's a good point. And to your statement earlier, buyers aren't looking. Look, the reality is to get to this point, you've probably got upwards of a year of time
Right.
invested, but from both parties, the buyer and the seller. And ostensibly, the buyer is culturally in love with the seller and vice versa. So you all see the benefits to partnership. You know, it's to the buyer's it's in the buyer's interest to structure something that would permit the seller to get back to whole in
Right.
in in some form, the ways that we've discussed or otherwise. Do you really see buyers taking that hard stance, saying we're going to decrease your valuation due to the short-term fluctuation, and we're not going to give you any method of recovery? Do you see that a lot?
Not right now, but like back in COVID when the swings were more dramatic,
Right.
there were talks like that. I think there was just so much unknown. Right now, it's material. It's enough that these conversations are happening, but not so bad that there's talks of not showing a path back or maybe expense cuts to get to the right EBITDA. I think there's like kind of a breaking point on the revenue decline where cuts beyond just or better said, like thinking about deal terms is the better approach versus like relooking at the whole P&L. It doesn't feel like this is going to last an extended period of time. And so like nothing more severe needs to happen. But I think if the declines get into the high teens, the 20s even, then there then that's possible, where maybe both parties do press the pause button.
Yeah. Well, I mean,
Yeah.
that's not without risk either.
Right.
I guess from a buyer's perspective, just the time they've invested, the dollars they've invested to get a potential partner to this point, they don't want to do that. Like they
Right.
want to move forward. From the seller's perspective, it's not without risk too. Like who's to say that when the markets do recover, those buyers are going to be there. The multiples that they've agreed to historically are going to be there. That's the risk that you're taking. Obviously, if you're doing a transaction as a seller, it's in our experience, it's not just for the check. I mean, that's a big
Right.
part of it, but they're seeking to gain things that are going to improve the quality of their life, their team's life, their client's life. There's new resources, new organic growth capabilities. All of that's gone now if you hit the pause button. And who's to say that
Right.
that partner will be interested in you 2 years from now, 3 years from now? So there is risk, and certainly I think in our experience that they want to agree to something that is workable for both parties having a good outcome, but they don't typically want to walk away. They want to try to figure out a path forward. If something like
Definitely.
COVID comes along again, which changed the world, I can see where that outcome, pausing could be more of a rational decision. But all things being equal, I think these other methods, these other remedies are much more workable just to keep things moving along to get a deal done. So,
Absolutely. Yeah. And and just to build on that, the benefits of joining the larger firm, like these times of market volatility, like we speak with so many advisors that say that these are the times where they're able to gather assets. End clients are, they're wanting that guidance, the advice, and if they have questions, and it's a great time to gather assets. And the sooner you're a part of the larger firm with their support around communication and marketing and things that help proactively communicate with clients about what's happening and how it impacts their financial life, the better. And so just to keep moving towards that is
yeah.
great. Yeah.
Yeah, your ability as an advisor, as a part of a larger firm, wherein all of the business junk has been removed from your life, such that you can just focus on clients. That your ability to do so during these turbulent times goes up. And to your point, the good advisors who are being proactive, reaching out to clients versus sticking their head in the sand and trying to act like this craziness isn't happening, they tend to grow during these periods. And when they bring on the new clients from advisors who weren't good at doing that, markets recover and they're all the better for it. Okay. All right. So to kind of recap, one, it's a very real phenomenon, but buyers and sellers, well, the buyers aren't looking to get an unfair deal by lowering the valuation. And the remedies are, most importantly, one, that the buyer permits a pathway for recovery to the seller. So
Mhm.
even if there is a potential reduction in valuation, whether at that point of closing or at the retention payment, that due to a short-term market correction or bear, that the buyer at least is willing to insert language into the agreement that should the markets recover, the seller will be made whole. And we've
Mhm.
discussed a number of ways to get to that point, but that's the basic thing that the seller should be looking for is my partner willing to allow me to be made whole when the market does ultimately recover?
Mhm.
That's the punchline, I think.
That's the punchline.
That's the punchline.
I'm just thinking about one part of this too. Keep an eye on if you're receiving equity in the transaction, the thought process around you know long-term view on the valuation of this business that's being acquired. What valuation is my equity being granted at? Is market activity, is the current run rate being factored into that at all? And is that, in sync? Like if buyers coming to you and saying, we're taking it from a 10 to a 9, I think also inquiring about the valuation of the enterprise equity that
Are
you're
they
being
doing the
granted in
same
the
thing to them?
transaction. Are they doing the same thing to themselves?
Great
That
point.
will be
Good
that
point.
will be
Yeah,
important
great
too.
point. That's a great question to ask. If you're asking me to lower my valuation and I'm rolling equity, are you lowering your valuation based on that too?
Mhm.
Excellent point.
Yeah.
Excellent point. All right. Well, good deal. Well, so hopefully by the time this gets out and people are listening to it, maybe the markets have fully recovered and we're not worrying about
Yeah.
it.
We're not hearing the tariff word and all the things.
Yeah, I do feel that even though sometimes this market volatility can cause short-term pause and disruption, on the other side of it, we tend to see an increase in activity.
Absolutely.
Yeah, because sellers, they realize, hey, if I have to go through this again, which we will go through again, I'd much rather be a part of a larger organization with resources and capabilities that help me weather the storm without having to do it solo. All right. Well, awesome. Well, hey, I interviewed you. I thought I did a pretty good
I
job.
know. That's good. We'll have to do that more often.
All right.
Great.
Very
Have a
good.
good one, Alex.
Thanks.